There are 2 or 3 key concepts within the Darwinex ecosystem that you must handle correctly if you want to attract investor capital in the future. I'm going to explain one of these concepts in this video, which is divergence. Alright, disclaimer. And we begin. If you have some trading experience, you've likely encountered the term divergence, often used by technical analysts to describe a mismatch between price action and the movement of a technical indicator. However, what exactly is divergence within Darwinex ZERO? For us, at Darwinex, divergence means something different. Basically, it's the difference in profitability obtained between a Darwin and the investors who remain invested in it, meaning those who have invested in said Darwin. Within the Darwinex ZERO platform, we don't have this data available yet, but we do in Darwinex Classic. Let's navigate to Darwinex. We'll use TAR as an example. Click on Investors, and then scroll down to find the Divergence Percentage section. As you can see, for the 6-month period, if we hover over the graph, we'll see that the TAR Darwin achieved a gain of 3.76% over that period, whereas the investors gained 3.31%, indicating a divergence of negative 0.45% exists. This divergence will increase as time goes by. If we look at the total period, we'll see that it has been gradually increasing for various reasons we'll cover later. One of the most important points you should monitor, whether you're operating in the Darwinex ZERO subscription model or have a real Darwinex Classic account, is to maintain this divergence above negative 0.4%. If this situation occurs, the following consequences will arise. For a real Darwinex Classic account, the Darwin could continue receiving investment from third parties but would be temporarily excluded from Darwinia, whether silver or gold, while this divergence remains this high. For a virtual Darwinex ZERO account, the Darwin would not be able to receive further third-party investment and, additionally, would be temporarily excluded from Darwinia, similar to the previous case. Furthermore, ZETs that already have previous investors could continue to have them invested regardless of the divergence reaching this limit, meaning it wouldn't lose those investors due to this specific issue. In both modalities, the Darwins would not drop a league if they were in gold, they would only be temporarily excluded. Dropping a league would require failing to meet certain Darwinia gold retention criteria, which we previously detailed in this video, linked here for you. So, what causes divergence? There are 4 primary factors that contribute to divergence. To begin with, as you're aware, Darwinex utilizes a proprietary algorithm to mirror trades from our signal accounts into the corresponding investable indices, or Darwins, through the risk management engine. Well, although it might only take milliseconds, the signal replicators require time for this process, and this time adds up, minimally reducing the profitability between what we could call the master account, meaning our signal account, and the account where it's replicated. In this case, our Darwin. Depending on the type of trading we carry out, the divergence could be greater or lesser. The more times the algorithm repeats the replication procedure, the greater the divergence will be, simply because there are more opportunities to increase those milliseconds. In other words, a scalper will always suffer more from divergence than a swing trader, because the former makes many more trades than the latter. Does this mean scalping isn't possible on Darwinex ZERO? No. It means the scalper needs to monitor this element even more closely. Furthermore, building on this last point, it will also be influenced by abrupt market movements and volatility. For instance, if we trade the Nasdaq 100 around the opening of the American session or immediately following a Federal Reserve interest rate increase announcement, the price movement, logically, will be very erratic. Be aware that if a trade lasts merely a few seconds, it's highly probable that there won't be sufficient time for accurate replication of that trade. Investors always enter and exit the trade after you. Let's look at this much better with a graphical example. Imagine you're trading long with a breakout strategy. You, the trader, would initiate your position at this price point, anticipating an upward price movement using a buy-stop order. Conversely, the investor, via the Darwin, would enter at a less favorable price after your entry, should the anticipated movement materialize. Suppose your target is located at a prior peak area. Upon reaching this level, you exit the trade, fortunately timing your exit almost perfectly, and then, immediately afterward, the price reverses in less than a second. Remember, your investors always exit after you, in this case, lower. You'll notice that the difference between your profit and your investor's profit may not seem substantial, but if we add up one operation after another, it can become considerable. By the way, I've opened a Patreon account to offer consultations to anyone interested. This involves a 1-hour one-on-one session where you can converse with me and directly address any queries or concerns regarding Darwinex and Darwinex ZERO. We can analyze your Darwin, identify potential solutions and enhancements, align your trading with the risk management engine, and optimize outcomes. I'll leave the link in the description of this video. Take a look. How could we improve this diligence? Let's do a similar example. Let's imagine now that we were operating long, but this time with a mean reversion strategy. You, as a trader, would enter at this specific price point, anticipating an upward reversion with a buy limit order. Nevertheless, the investor, via the Darwin, would enter at a better price after you if the movement you expected finally occurs. Suppose your target is located in a prior high area, and upon its attainment, you close out your position. With such bad luck this time that the price strongly and quickly breaks that resistance and continues upwards. Remember that your investors will always exit after you, in this case, at a higher level, obtaining a larger profit run both on the entry and the exit. Should all your trades hypothetically unfold exactly like in this final example, the divergence between your personal account and the Darwin would actually be positive. In other words, your investors would be obtaining more profitability than you. In your Signal account. Please note that these two examples provided a hypothetical, and it's highly improbable they would consistently happen in the same manner, but I believe they illustrate the concept clearly. Don't you agree? If not, please let me know in the comments. I'm not sure if you've realized, but I've omitted one of the primary factors. This factor merits its own video. I'll explain it right here. See you next time.